Good morning, everybody, and welcome to HUBsights. I'm Anne McDonald, the Head of Marketing here at Hub24, and today we're fortunate enough to have with us John Julian and Rory Shapiro from AMP Capital and Richard Elmsley from Rare Infractructure, and they're going to be talking all things infrastructure very shortly. So just before we kick off, I'm just going to mention a few housekeeping items. The lines will remain muted throughout the presentation to prevent any background noise. So if you have any questions, please use the webinar control panel to send them through to the team, and we'll hold a combined Q&A at the end of the session. So without further ado, I'll hand over to John and Rory.
Thanks very much, Anne. Great to be here today to talk on the topic of infrastructure. I find infrastructure to be an absolutely fascinating topic. It's clearly really important to our economy because it helps to drive economic growth, but also it's absolutely integral to our daily lives, and indeed it actually enables our society to function on a day-to-day basis. Infrastructure consists of a very broad range of assets, which can include things like schools and hospitals, electricity and gas distribution networks, and of course roads, rail and airports. And I think the reality is that most of us, if not all of us, would probably use infrastructure multiple times on any given day. There's currently a massive need for infrastructure spending around the world, and that's to replace or upgrade existing infrastructure in developed markets, and also to cater to trends like urbanisation and population growth in developing markets. There are any number of surveys out there which estimate the level of infrastructure spend that's actually required. And the common theme across all of them is that the numbers are huge. For example, McKinsey Global Institute recently estimated that US $3.3 trillion is required to be invested in economic infrastructure each and every year through to 2030, just to keep pace with projected growth. And of course, this is happening at a time when public balance sheets around the world are constrained, meaning that there's a large and growing need for the private sector to help fund society's infrastructure needs. Infrastructure is an asset class that I believe is really exciting. It's going from strength to strength and can offer some very compelling benefits to investors. So for the first part of this webinar, Rory and I are going to be talking about infrastructure as an asset class, what it can offer investors, and importantly, what are some of the key risks that apply when investing. We'll touch on the different ways investors can invest in infrastructure and look at the impact of including infrastructure in a broader portfolio. And then to conclude our presentation, we'll look at a couple of brief asset case studies just to give a bit of flavour to the types of assets that we look to invest in. We actually conduct regular surveys of investors, and in our most recent survey a couple of months ago, we asked respondents to identify what they saw as their main investment-related challenges. And the survey respondents identified market downturns, investment selection, and maintaining income levels as being their key investment challenges in the current market environment. I think that the infrastructure asset class has characteristics which can help investors to address these challenges.
So before we get into the detail of what infrastructure offers to investors, it's important to understand what infrastructure actually is. So broadly speaking, infrastructure assets provide or facilitate the provision of essential services which help to drive economic growth and underpin the day-to-day operation of a society. In practice, the infrastructure asset class encompasses a very broad range of assets, and a common way to look at the asset class is by sector. So some key sectors include social infrastructure such as schools, hospitals, justice facilities and car parks, utilities like water and electricity, gas transmission and distribution networks, transport infrastructure, so things like roads, rail, airports and seaports, and communications infrastructure, so things like mobile phone towers. Now, while each infrastructure asset can have some common characteristics, it's important to remember that each asset is unique and it's subject to its own specific risks and characteristics. So what this means is you really need to look beyond the broad infrastructure classification into the underlying asset to understand what its key drivers are and what risks and benefits it offers to investors.
Okay, so what are some of the things that infrastructure can offer investors? I think infrastructure offers three key things. The first is it can offer attractive and consistent returns through market cycles. And that's because infrastructure assets are what we call essential services assets. So they're assets that need to be, or that people have to use on a day in and day out basis. And to illustrate that with an example, one of the assets we invest in is a company called Powerco. Powerco is the largest electricity and gas distribution business in New Zealand, and it provides energy for lighting, for heating, for cooking and so on to a significant percentage of the New Zealand population. That's exactly what I mean by an asset which is an essential services asset. And it's due to the nature of the essential services that assets like this provide that they tend to be less influenced by economic factors than many other more traditional types of assets. Secondly, infrastructure can provide consistent long-term income yields. And that's because infrastructure asset revenues are often underpinned by regulation or by long-term contracts. And again, to try and illustrate that with an example, one of the assets we invest in is a group of 6 school facilities located in and around the city of Adelaide. And in return for the use of those facilities, the South Australian government pays us a fixed amount every quarter for the next 21 years, provided those facilities are available for their use. And that, as you can imagine, gives us a very high level of visibility and also certainty around the future income streams that will come from that asset for the benefit of our investors. And then, of course, infrastructure asset revenues are often linked to inflation, and that can help investors to protect against the erosion of the value of their investment by inflation over time. And then thirdly, diversification. Your overall portfolio diversification is improved when asset values don't behave the same way at the same time, or to use a more technical term, where assets have a low level of correlation. The infrastructure asset class, and unlisted infrastructure particularly, shows very low levels of correlation with listed markets, meaning that its inclusion in a portfolio is an effective means of reducing overall portfolio risk.
With any investment, it's important to consider the risks as well as the benefits, and this includes the infrastructure asset class. Risk identification, mitigation, and ongoing monitoring and management is critical for any infrastructure asset. Some of the common risks that can apply to many assets include interest rate sensitivity and refinancing risk. Now, it's very important that an asset's capital structure and its level of gearing are robust and sized appropriately, having regard to the quality and stability of the underlying revenues that the asset generates. Another risk is lack of liquidity. So listed infrastructure securities are highly liquid. However, unlisted assets can be large and complex operating businesses and can take time to liquidate. Other common risks include regulatory and political risk. So for certain types of infrastructure assets, the fees they are allowed to charge for their services are set by a regulatory body. So an adverse regulatory decision can have an impact on the revenues that these assets generate and consequently on the value of those assets. In addition, every infrastructure asset is subject to its own risks that depend on its operating environment. Now, we've talked about the benefits that infrastructure can provide to investors, but how can they access it? Well, there's 2 main ways that investors can access infrastructure assets: through unlisted, otherwise known as direct infrastructure, or through listed infrastructure securities that are listed on global stock exchanges. Now, both of these approaches invest in the same types of underlying assets, and theoretically, they should produce similar returns over the long term. However, each investment approach has its own differentiating characteristics and can bring its own benefits to a portfolio. For example, the major benefits of listed infrastructure are diversity and liquidity. In other words, a diverse portfolio of infrastructure securities can be acquired and conversely sold in a short space of time. The major benefits of unlisted infrastructure are stability of valuation, otherwise known as low volatility, as unlisted assets are not exposed to the speculation that occurs on listed exchanges. And another benefit is control. Control is important for an infrastructure manager as it provides significant opportunities to drive value and manage risk in an asset through active asset management. Conversely, unlisted infrastructure assets tend to be relatively illiquid, so they can be hard to sell in a short space of time, whereas listed infrastructure tends to be more impacted by market sentiment. So consequently, the valuations of listed infrastructure tend to be more volatile and also tend to be more correlated with broader equity markets, and therefore, in a portfolio, they tend to provide less diversification when compared to unlisted infrastructure. Combining both listed and unlisted infrastructure in a portfolio can bring together the best features of each and deliver an infrastructure investment solution that can produce attractive returns with a lower level of portfolio volatility.
So the next couple of slides are what I think of as really the investment case for infrastructure. So why would you include it in a portfolio? And the chart on this slide is a risk-return chart that compares the relative performance and volatility of infrastructure in various forms with a range of other asset classes, including global equities, Australian equities, global bonds and global REITs. And what the chart shows is that over the last 10 years, infrastructure in all its forms provided good investment outcomes. Unlisted infrastructure provided strong returns at relatively low volatility, and listed infrastructure also provided strong returns and indeed outperformed general equities with a comparable level of volatility to listed assets. And then a combination of unlisted and listed infrastructure delivered both good relative returns and also low volatility. As I mentioned earlier, your overall portfolio diversification is improved when your asset values are not correlated. That is, they don't behave the same way at the same time. And this next chart compares the correlation of infrastructure with other asset classes. And I suppose the main takeaways for me from this chart are firstly that listed indices are generally fairly highly correlated, and that suggests that it would be harder to build a very well-diversified portfolio constructed only of listed assets, despite the fact you may have some asset class diversification. Bonds have low or negative correlations with the other asset classes, suggesting that they will be an effective diversifier. However, the trade-off there is the lower bond returns. Unlisted infrastructure also, like bonds, has low or negative correlations, suggesting that it provides good diversification. And then the combination of unlisted and listed infrastructure has relatively low correlations with other indices, suggesting it can also be an effective diversifier.
So in the context of exploring infrastructure, we thought it would be helpful to provide some case studies to give some specific examples of infrastructure assets that AMP Capital manages. One of these assets is Melbourne Airport. Melbourne Airport is Australia's second busiest airport, and it has serviced over 35 million passengers in the last year. It was acquired in 1997 when it was privatised by the federal government under a 50-year lease with a 49-year option to extend. So it's essentially a 99-year asset. AMP Capital manages a 47.6% stake in this asset and is the largest shareholder, which means it plays a leading role on the board. The great thing about this asset is it has a very well-diversified revenue base. So most people would think that an airport makes most of its money just by aeronautical charges. However, for Melbourne Airport, it makes about 46% of revenue from aeronautical charges, 22% of revenue from car parking and ground transport, 16% of revenue from retail, and 16% of revenue from property. This asset has delivered a strong performance for our investors over the long term, and we would think it will continue to enjoy growth opportunities in the years to come. We've been experiencing strong growth in both domestic passengers, and it's actually been outperforming the broader Australian domestic air travel market, as well as international passengers. And we expect this to continue, particularly for the international segment. And that's really what you want to see, because international is where you want growth, because a typical international passenger delivers about 2 to 3 times the revenue of a domestic passenger. This international passenger growth is driven by growth in tourism from China and a range of other Asian countries, as well as from the UK and the US. One of the other areas that we see future value is property development. So Melbourne Airport has an enormous land bank with over 2,400 hectares, which makes it almost 3 times the size of Sydney Airport. And of this 2,400 hectares, 300 hectares are zoned for commercial development. Given its location, this land is ideal for logistics, warehousing, and distribution businesses. At a present rate of development, which is 10 hectares per annum, land is available for development for the next 30 years. There's also a few other interesting facts about the airport. So it actually services the world's second busiest air route, which is between Sydney and Melbourne, and its car park is one of the world's largest, with over 27,000 parking bays.
So Melbourne Airport's an example of an asset that we see very much as a growth-orientated asset. SA Schools, which is our second case study, is an example of an asset which is an asset which essentially generates a high income yield. So schools are part of what is commonly referred to as the social infrastructure sector, and that's a sector which also includes things like hospitals, justice facilities and car parks. Social infrastructure assets tend to be at the lower end of the risk-return spectrum, and one of the features of their return profile is that they tend to generate a high cash yield. And for that reason, we see them as a valuable component in a well-diversified portfolio. So the SA Schools project consists of 6 school facilities, 3 primary schools, 2 high schools and 1 special needs school. And those 6 schools collectively accommodate over 4,600 students. We invested in the asset under a long-term contract that it runs through to 2039. And essentially under the contract, we provide and maintain the physical facilities while the State Education Department employs and provides the teachers to teach at the schools. We're essentially paid for keeping the facilities open and available for use. This asset delivers a high cash yield in the high single digits, and the revenues it generates are very secure. And that's because we receive availability revenues, meaning that we take no patronage or usage risk. And in fact, we would actually be paid even if there were no students enrolled at the schools. And then in addition, because the revenues come from a secure counterparty being the South Australian Government. So infrastructure has traditionally been and continues to be very popular amongst institutional investors. And that's because it can provide a range of features such as attractive returns, low volatility, and effective portfolio diversification. As I mentioned earlier, some of the themes that investors tell us they're concerned about in the current environment include things like market downturns and maintaining income. I believe that the infrastructure asset class has characteristics that can help address those concerns and that it's a very worthwhile addition to a well-diversified portfolio. So that actually brings us to the end of our part of this webinar, and I'll hand over to Richard.
Thanks, John. Look, I agree with everything John said. It's a very interesting asset class. It's an asset class that's growing quite significantly. Both listed and unlisted provide investors with assets that have very stable cash flows. You get a lot of your income through dividends. The volatility is generally a bit lower than global equities. The beta for listed is actually quite low in times of economic stress. So both asset classes in our view, and I was in unlisted for 14 years till 2006 or 2004 and decided to go into listed back in 2006. And my main belief was that I thought that we could offer a product to investors that they weren't getting access to back in 2006, and that was listed infrastructure. And over the long term, the risk return profile between listed and unlisted should be very similar, because these assets tend to have the same regulators, and John and Rory mentioned that sometimes control helps. Well, yes, sometimes control helps, but sometimes you don't have to own 100% of it. And by way of example, if you look at the UK water companies, there were 10 water companies floated by the UK government back in 25 years ago. Today, 3 are listed and 7 are unlisted. If you look at the operating performance of all 10, when they were first floated, there was a large disparity between all 10. Today, if you look at the operating performance, there is virtually no difference between the operating performance of a listed or unlisted. And you would expect that because they've got the same regulator. The primary difference between investing in an unlisted water company and a listed is gearing. In an unlisted water company, you create a special purpose vehicle, and it is geared, and it'll acquire the underlying asset upon which the regulator will apply the regulation. So when you look at the unlisted and listed, you do need to have a look at the gearing. But the assets are very similar. I think Melbourne Airport's a fantastic asset. John may not be aware of this, but actually I was the joint team leader that set up all the regulation for airports in Australia and then sold the airports. And his consortium won by $10 million, which wasn't very much in those days. And they've made a tremendous amount of money out of Melbourne Airport, and it's a fantastic airport. But equally, Sydney Airport, which is listed, is a fantastic airport, and similar returns have been made out of that, and you've got the liquidity. Auckland Airport's also been given very good returns over a long term, not quite as much as Melbourne, but you've got the liquidity. So it's the listed market does provide liquidity. It has a little bit more volatility. I might just in terms of the listed market, in terms of rare, look, we've got a balanced product, which is value. I just wanted to mention that we're a specialised manager. All we do is listed infrastructure. We provide a balanced product. If people want a higher income, we have a product that provides a 5% income through the cycle, and we have a product which has got higher growth, and that's investing in the emerging markets. But it's all the same type of infrastructure as John and Rory mentioned, really core infrastructure, utilities, and infrastructure like airports and roads and communication assets. In terms of the valuations and how, first of all, I guess you need to look at the economic outlook, because when you look at the valuation of an infrastructure asset, what really drives the valuation is in-country GDP, because an economy is doing better. People are probably more comfortable to use a toll road. They're secure in their jobs. As economies don't do as well and you're less secure in your job, you're probably going to catch a free road, drive on a free road, or do rail. So in-country GDP is very important. These assets generally have an inflation hedge, so in-country inflation is very important to these assets, so it's long and short bond rates. So how an economy is going will drive how well an infrastructure asset does. Having said that, through different economies up and down, these assets do exhibit far more stable cash flows than your general equities. And in our view, if I look forward in the markets, is that, when we go to the US, which is the biggest market, wage pressure is quite tame at the moment in the US, to be frank. Profit margins are widening, bank lending is a bit easier. You combine that with a good fiscal policy and structural reforms that are breathing life back into the current cycle, inflation grinding a bit higher, so rates will go up a bit more. That's a pretty good environment to invest in. Europe's not dissimilar, came off a little bit the last few months, but we expect to see some growth in Europe. I think inflation will pick up a bit in Europe. In Germany just recently, there's been a number of wage cases where we've seen quite significant wage increases for some of the industries over there, which should start to translate to a little bit higher inflation. So it's a good environment to be investing in infrastructure, both the utility type assets and the essential service type assets. If I have a look on this next page here, well, this is just showing the relative returns of infrastructure to global equities, and on a relative basis, we'll come back to about the same pricing as global equities, but global equities have increased a lot in the last few years because of PEs going up, whereas in infrastructure we've seen relative stable EBITDAs over the last 5 years. What we have seen is the asset base grow quite significantly. If you look at the US utilities, their asset base is growing at about 5 to 6%, many of them, and you're getting a nominal return of 10%. And we get rewarded on the asset base. That's how you make money in infrastructure. So I think it's probably far better to have not too much multiple expansion, but your underlying asset base increasing. On this next page, I'm just using as an example here our income strategy, where we're trying to achieve a 5% yield, but in general listed equities at the moment, people would be getting about 4% if you just want a normal type of exposure. So although these assets might be a little bit more volatile because they're listed, you are getting a large component of your return in dividends, and that dividend is very stable across economic cycles. So should stock markets decline, the actual cash in these businesses are pretty stable, and you're going to continue to get a very good dividend. And as I said, in this example, you look back the last 5 years, the compound annual dividend rate's been about 8%, and we've seen a similar increase in the asset base of about 7.5%. Compare that with inflation running at about 2%. It's a pretty attractive place to be investing. But have a look at this next page. Look, I just want to show you this. This is just looking at EBITDA multiples to your enterprise value, and across different sectors and across different regions. And look, red is obviously getting expensive. Green is good value. The more dark, the better value. White, we're not investing in those regions. But what it does show you is just that not all assets in the asset class are good value today. Some are better value, some are worse value. And the advantage of being a global investor in listed infrastructure is that you can actually pick where you want to invest. And for RARE, we're an absolute manager, so we're not influenced by infrastructure indices. And in terms of valuation, if I turn to the next page, our base valuation tool is an equity IRR. So what would you expect to earn from this asset if you invested on a 5-year period? And if you compare the real equity IRR to the real cost of equity, in many regions, we're seeing some pretty good value across different sectors and across different asset classes. And you can see there in some regions, some asset classes, we're not seeing any value at all. And by way of example, an asset that's in our portfolio, and I notice it's also in the AMP portfolio, is a company called Enbridge. I don't know if people are familiar with Enbridge, but effectively it's a gas and oil pipeline company in North America. It's the largest gas and oil pipeline in North America. It's got an enterprise value of about $165 billion. It's got a yield of about 6.8%, growing at 10% a year. 96% of the cash flows are take and pay contracts or utility-like. 92% of their customers are investment grade. It's a very attractive business. For us at RARE, where we're trying to do an absolute return of G7 inflation plus 5.5, which is running at about 7.2, if I can get a yield of 6.8 growing at 10%, I'm clipping most of my return from the income from this business. And we think it's actually quite a cheap asset. And if I turn to the next page, I just wanted to point out the growth in these assets and the valuation that we do. So that middle row there is the equity IRR. So if you started with this asset being worth, which it was recently, $38.52, and you look forward 5 years, there's about $14 worth of 80 of dividends. Our view is in 5 years it might be worth around $60, and that's based on discounting the cash flows out 20 or 30 years back to year 5 using a long rate. So what that shows you is that we think, as the analysts think, look, you're going to get a capital gain if you hold this for 5 years of about 9.3%. You're going to get income of about 6%, nominal return of 15.6%. That's a real return of 13%. For us, though, we step back and say, well, what's the hurdle rate? What's the minimum return I should get? The minimum return you should get is to cover your cost of equity, which, using a capital asset pricing model, is about 4.1%. Our view is you should be rewarded if a stock is illiquid. So it can be illiquid because it's just illiquid, or because I've got a very large holding, and to sell that stock, it would take me a while, and therefore I should be requiring a higher hurdle rate. And we price that with an outside party. In this case, it's saying you should be rewarded an extra 40 basis points because we own a lot of this asset. And that illiquidity premium is quite important because presently in the unlisted market, I'm not sure you're getting rewarded for the illiquidity premium because there's a lot of dollars that have been raised in that market chasing very few assets. We do try to look at environmental and social as quite important. So if a company has good environmental and social policies and they're adopting those policies, there's less risk to the cash flows being affected by an environmental and social issue. In this case, we think they have good policies and we've reduced that hurdle rate by a little bit. And PM comfort where there's nothing is really corporate governance. So what we're saying as a portfolio manager, I need a return of 4.4 before I invest. The analyst is saying, if you hold this for 5 years, you should get 13. That's a large excess return, and we think you should be buying that asset. Clearly, AMP think that too. They have a reasonably large holding in it. And this company has sold off a bit last year. I'm not sure when AMP owned it, but it hurt our performance a bit last year because it came off. But we're in another company called Shaneri, which has done very well, and we're in that at about 42. It's a similar business in America, and it's about 60 today, and we have been lightening in that because it's liquid, and we've been putting our money from that more into Enbridge. So now we own over 6% in Enbridge. And that ability to liquidate a stock because it's getting fully priced relatively quickly and move it into another stock is one of the advantages of being enlisted. As John and Rory said, it's much harder. An unlisted asset will take you probably 6 months to dispose of if there are buyers out there and you run a good process. So one of the advantages of being enlisted is that you have got that liquidity, you can take advantage of it and move into other assets. Look, this is the value strategy, and I don't want to talk about the strategy itself. I just wanted to talk about the bottom left-hand corner. These are big companies. I mean, the average market cap is about $30 billion. They've got very good underlying yields. The underlying yield in our portfolio might be similar to AMP, is about 4.4%. That's a very healthy yield when we're trying to achieve an overall return of 8 or 9%. You've got dividend growth here of about 7.6% in the portfolio, so that's a fantastic growth in your dividends over a 5-year period. They're not heavily geared. The gearing you're looking at here is not that we gear as a manager, it's the look-through gearing of the companies, and it's running just under 40%. And you've got an interest cover of 4.3%. And at the same time, I'm telling you the valuations look relatively attractive if you look out a 5-year period. That doesn't mean that we won't get a dip in stock markets, but on a 5-year period, we think you'll do pretty well with assets that are got not too heavily geared, got healthy interest cover, and you're getting a large proportion of your return from dividends. Sorry, I'm just trying to turn to the next page. This is just looking, because we use an IRR, the forward-looking IRR, and you can see that over time, the IRR, we went back to 2012, and you look forward 5 years, it was about 14%, and maybe back in 2012, people have done that 12 to 14 in that period, and the IRRs have come in a lot. But the asset prices in some of these assets have come in a little bit because of our view that North American bonds were going to rise. We've been a little light in the utilities over there because they'll come back a bit. If you went back to last September, they were pretty fully priced. We had no excess return. And those assets are off 15 to 20% through to January. They've risen a bit again in the last few months. We think they're reasonably fully priced, but they might come off again as bonds go up. But a forward-looking return, if this is correct and it's been reasonably accurate, is just around 12%. Looks pretty attractive for a 5-year period. If I just conclude, I mean, look, we think the valuations are reasonably attractive today. Some sectors are pretty fully priced in the market globally. Others are showing pretty good returns, comprising of a substantial amount of income as well as some capital. I do think liquidity is very important. People forget that when you really need liquidity is when you've got times of extreme economic stress. And if you went back to 2008, a number of the closed-end funds actually weren't open to investors. They had to stop redemptions because of what was happening in the market. And this is a very liquid asset class, so you can get good liquidity. Very stable cash flows and dividends through the economic cycle. That's both for listed and unlisted. Both listed and unlisted, all these assets that we're investing in have very healthy inflation hedge. And although inflation hasn't been a problem for the last few years, there's a chance that it could take off. We're not expecting to take off, but we do expect it to rise a little bit. And it's healthy to have a bit of inflation, to be frank with you. And these assets will benefit from inflation. In some cases, we get a real return, but in most cases, these assets put their price up by inflation. And you get pretty good diversification. John mentioned the correlations are close to global equities. Our view is it's about 0.6 to 0.8. But the more important one is that the beta in times of economic stress is, on our analysis, is closer to 0.4, 0.45, and that's a very attractive feature to have. And clearly, not on this last page, but very important to listed is liquidity. You do have liquidity in listed. You don't have it as easily in unlisted. And as I said at the beginning, my strong view is that if you're big enough, you should be in listed and unlisted. For most retail investors, I think liquidity is quite important. But it is a very attractive asset class, as John and Rory started off this conversation.
Thank you. Well, some very interesting case studies there on the infrastructure sector. So now's the time, if you have any burning questions for any of our presenters, to send them through via the webinar control panel. But I'll just kick them off here. For the AMP Capital team, is regulatory or political risk something you consider when investing in infrastructure?
Yeah, look, absolutely. Depending on the class of infrastructure asset you're investing in, regulatory or political risk can be a very major factor in your considerations. So it's an area we spend a lot of time on, both when we're looking at potential new investment opportunities and also when we're managing existing assets under our stewardship. So it's an area that we focus on significantly in our due diligence, and that's by virtue of our in-house resources. We've got a global investment team of just north of 70 infrastructure investment professionals located in the key markets around the world, and a key part of their role is to be plugged into the regulators in the environments in which they're investing, and also we'll use third-party experts in regulation in various jurisdictions for various purposes as well.
Okay, great. Yeah, just one that's come through just now, and I'm not quite sure who this is for, so we'll open it up to the panel. Why are current listed and unlisted market valuations so different?
Well, I'm going to start with it, I guess. Part of it's supply and demand. In core infrastructure, which is what everybody really wants because it's got the very stable revenues and lower risk, the prices of those assets have gone up substantially in the last 10 years. So the type of returns that John's getting out of Melbourne Airport, you wouldn't be able to get today if you bought a new asset in the market. And there's been a lot of money coming into this asset class, both listed and unlisted. And I think prior to Trump going to Saudi Arabia recently, I think in the unlisted market, Prekin was saying about 130 billion that had been raised and looking for a home. Following Trump, Blackstone came out and said we're going to do 40 billion, and there was 20 billion, I think, supported by the Saudis. So that's 170 billion looking for assets, and these assets only come up because of secondary sales or governments wanting to sell. So in the unlisted market, the prices are pretty tight at the moment. That's how we're seeing it. We think the listed market in some sectors are also quite tight, but in other sectors you're seeing quite good opportunity. That's a generalisation, but there is a lot of money in the unlisted looking for a home at the moment.
Yeah, look, I generally agree with all of that. Probably the one thing I'd add is that in the unlisted market, I mean, you can cut the unlisted infrastructure market up like a patchwork quilt. There are a whole range of different sectors, range of different geographies, and we're seeing different competitive dynamics in different parts of that patchwork quilt. So there are undoubtedly a number of areas where we just don't see value at the moment in the unlisted space. But there are also some areas where we think you can still invest in a decent asset at a reasonable price.
And sorry, I think to add to that as well, so a recent example that we've seen was towards the beginning of this year, we saw interest rates, long-term interest rates spike up a bit as there were wage inflation pressures in the US. And I think that was an interesting example of unlisted infrastructure and listed infrastructure behaving differently. So I think with listed infrastructure, at least some of the assets that we saw, with that expectation of increasing interest rates, it led to a bit of a decrease in value. But in the unlisted portfolio, what we were seeing was the independent valuers that valued our assets had already incorporated expectations of that interest rate hike. So as a result, we saw a bit of a disparity in how they responded to that. So I think just in certain circumstances, it really varies what the response will be, depending on what the market stimulus is and the valuation basis used. So I think just another example of a difference between listed and unlisted there.
Okay, fantastic. And just one here for Richard as well. Can you give us an idea on emerging markets infrastructure and what the drivers are for emerging markets and which regions you invest in?
Sure. Well, there's more growth in the emerging market infrastructure than there is in developed markets. I think John mentioned there's been a lot of studies done. One we saw was Hale Economics. They thought that by 2030, infrastructure will have gone up by about 124% to $110 trillion. There was a doubling in the developed markets, but it was a trebling almost from 22 to 60 in the emerging markets. And if you step back and you think about it, and these assets that I'm talking about are exactly the same type of assets that we've all been describing. So they're the essential services, gas and electricity, distribution and transmission, roads, airports, rail. These assets, when the emerging markets, to emerge, you have to have good infrastructure to move your goods and services around. As you emerge, per capita income increases. And as per capita income increases, people can afford cars and more things. And as you get more assets, we're getting a return on the assets. So there's more money going into the ground, there's better returns. And a lot of the regulatory environments, and for that matter, the contracts that are being entered into are being copied from the developed market. So they're not as risky as people would think, and that's not to say in every emerging market, but many of them, if you take Mexico, for example, it's got dual-till airports. They're very long-term, like Sydney and Melbourne Airport. They've been around since 1990, almost exactly the same, but it's in Mexico. So we think there's pretty attractive opportunities. And I think actually being liquid is very important because it is emerging markets. So if something goes wrong, I can actually liquidate. I might make a loss, but I can liquidate. If you're in a unlisted, you've actually got to wear that regime. So we think there's a lot of growth in the emerging markets, and we think that it offers a good opportunity for investors to play the emerging markets in maybe a lower risk way where you're getting stable cash flows, and again made up of high dividends.
Right, great. So it looks like we've reached the end of our webinar today. So thank you again to John, Rory and Richard for coming in to present. Keep an eye out, everyone on the phone, for our next webinar series. And if you'd like to get in contact with any of our presenters here today, then please let us or your BDM know. Thank you very much.
Thank you.
Thanks.